I'm wondering your thoughts on the landscape that Kevin Warsh is walking into here as the new Fed chair, with the market today after this PPI report and yesterday's CPI seems to be betting on a rate hike more likely than a rate cut. Should he start turning away from Truth Social while he has the chance?
Well, he's certainly walking into a challenging environment. I mean, take away the politics. You know, the transition from one Fed chair to another is always an important moment and often difficult to make it seamless. So they've got that going on to begin with. And, you know, today's data is sobering. The PPI numbers suggest that there's some pipeline inflation that'll show up in the CPI and the PCE measures further down the road. That's not great news. When you look at the CPI numbers that came out, the energy prices we all understand, food, yeah, you know where that's coming from. Shelter inflation was over 7% at an annual rate. I mean, that's a troubling number. And if you start to see those components, the ones that have been sticky in the past and have been problematic for the Fed to get to 2%, if they start bouncing back up, then you have a problem. And I think Warsh has got to be looking at that really closely. And then the last thing I'll flag is that he has been making the case that these great productivity numbers are going to allow the Fed to cut, even if all these other factors are taken into account. The great productivity numbers went away in the first quarter. We're at 0.8% for the quarter. And, you know, that doesn't add up to what he'd hoped. And he's got a real challenge facing him.
Well, certainly so. So when we have these questions around monetary policy's ability to navigate this economic environment and address some of these inflationary pressures, obviously the Fed doesn't necessarily have the tools to do that. But does the federal government have those tools either, Doug, if this is mostly an issue that is concentrated in the Middle East and specifically the Strait of Hormuz?
Well, if it's strictly an energy story and it is relatively short-lived, then, you know, as Michael pointed out, you can look past it. The Fed will look past it. There's nothing that fiscal policy could do in those circumstances. If you start talking about longer horizons, well, it'd be a good idea for fiscal policy to do the Fed a favor and not run $2 trillion deficits at full employment. So, you know, they've gotten no help whatsoever, independent of administration. So there's no appetite for that to change right now. We see that all the time. But there will have to be a reckoning in the months and years to come of what the federal budget looks like and how it has to be brought under control.
Douglas, I just heard from a terminal user named Ryan who says, I thought Republicans were all about fiscal responsibility. He lists gas tax relief, tariff checks, huge Pentagon budget proposal, $25 billion spent on Iran. Interestingly, he did not mention a ballroom. There's a question about spending, about fiscal responsibility in this administration, Douglas, and we talked to someone who has your old job, Phil Swagel, who's the current CBO director, and we asked him about this idea that Hank Paulson floated of having a break glass scenario inside the Treasury if the bond market decides that it cannot endure this any longer. Here's what he said.
Look, the fiscal trajectory is unsustainable. But when will we start to see it? This is when will we see the kind of slow undermining of the economy come into an acute phase? We're not there yet. That's the challenge for policymakers, is that if something has to be done. It doesn't have to be done the second. But it's certainly worth thinking about it and planning for the worst while taking action to avert it.
Douglas Holtz-Eakin, where are you on a break glass scenario?
So there's a break glass scenario that involves the Treasury and financial markets. There's the work that Secretary Treasury Bessent's doing right now to set up swap lines to try to reinforce demand for the dollar and thus push off the day at which this break glass scenario is needed. All of these things are financial engineering that avoid the fundamental problem, which is the mismatch between taxes and spending. And they won't fix anything. Only higher taxes and less spending will fix the fundamental problem. How you finance it, red bills, green bills, purple bills, short-term, long-term, you can't disguise the fundamental problem that way. You can buy a little time, but that's all you really do.
Well, and tell me if I'm drawing undue parallels here. Doug, but when you look at what's happening in the UK right now, yes, there is obviously a massive question around Keir Starmer's future and whether or not he can hang on. But when you look at gilt yields at the highest in 30 years, there's obviously a question as to whether this is really about Starmer or a country that cannot seem to sort out its fiscal situation in terms of the amount that it would like to finance and its borrowing capability. And I wonder if what's happening in the gilt market you do think could soon come to treasuries, or if these things are fundamentally different.
So I think you ask a good question, because if you look at the numbers, in the United Kingdom or France, they have deficits that are roughly 6% of GDP. The U.S. has deficits roughly 6% of GDP. Debt to GDP is about 100%. That's where they are. And you're seeing international capital markets get a little skittish about those countries. Could that happen to the U.S.? Sure, it could. We've been downgraded 3 times. The first 2 times they said things like, well, your politics are super toxic. You can't manage your finances. That was true, but it wasn't about the fundamentals. Moody's said, you have too much debt, and interest takes up too much of your revenue. That's a very different kind of warning, and that says it can come here. And so I think that both the performance of the gilts and the worries that coming out of the rating agencies are something policymakers ought to take more seriously.
What's your hope on this trip to China? Douglas, the president's on the ground now in Beijing. He's got half of corporate America with him. And I realize there could be some big deals with Boeing, for instance, maybe NVIDIA. But how about when it comes to tariffs? The economic impact of tariff relief and the market reaction could be great. What do you think?
I think deals are great. And if it's Boeing or crops or something, wonderful. But the real fundamental thing has been, A, the 2 largest economies being engaged in an outright trade war, and it's sometimes just a complete standstill, and then B, the enormous costs of reshuffling the trade arrangements on the globe because of the fallout of that trade war. So finding a way to stand down between the 2 countries, take away the tariff battle, allow the economics to dictate patterns of trade, not the geopolitics, would be an enormous step forward. That would be the best outcome, I think. But I don't think that's in the cards immediately. Steps toward it might happen.
I guess we'll wait and see. In our final minute with you here, Douglas, if I could just ask you about this notion of a gas tax holiday, as we have now seen a number of lawmakers put forward legislation to achieve.
Please.
Well, I was hoping you might give it a letter grade, A to F. What's the rate?
F. You do know that I was the policy director. I was the policy director for the John McCain presidential campaign when he proposed a gas tax holiday. I had to travel this country defending it. It's a terrible idea. It won't do any good. It won't do any good. And when people realize it doesn't do any good, it backfires on you. So it's not even just buying time politically. It's a mistake. They should walk away from it.
Wow. 30 seconds, Douglas. Will it, in fact, raise gas prices by increasing demand?
Demand's pretty much set in the short run. I mean, for these holiday exercises, think 3 to 6 months, you know where your job is, you know what car you're driving, you know your commute. It's all locked in. You can't really change the demand very much. And so I don't think it drives it up. I think it puts some money in the pockets of the gasoline supply chain. And if that's what you want to do in a crisis, have at it. But I don't think it's going to play politically.